People look at SpaceX and see the road to Mars. With the upcoming IPO, millions of retail investors want a piece of that future. But the reality of a business is often distinct from the performance of its stock. On May 20th, 2026, SpaceX filed its paperwork to go public under the ticker SPCX. The company is targeting a valuation between $1.75 and $1.77 trillion, seeking to raise $75 billion from the public markets. This chart shows how completely that figure towers over historical benchmarks. Alibaba set records in 2014 by raising $25 billion. Saudi Aramco pulled in $29 billion in 2019. SpaceX is asking the market for nearly 3 times that amount. When a single company is valued higher than the annual GDP of Portugal, retail investors are entering at a level where even massive operational success is a baseline requirement to sustain the price. The math of this offering reveals the capital is earmarked for obligations beyond the launchpad. The real question is whether the underlying cash flow can actually support a $1 trillion price tag. For decades, the Pentagon operated on a strict rule for space and missile contracts: never rely on a single supplier. Today, the legacy aerospace companies that used to compete for those contracts have fallen too far behind to keep up. Boeing's Starliner crew capsule shows the reality of that decline. After NASA paid Boeing over $4 billion to build it, the first crewed test ended with 2 astronauts stuck on the International Space Station for 9 months, eventually needing a SpaceX vehicle to bring them home. Because of failures like that, the U.S. military finds itself dependent on SpaceX. When the Department of Defense needs a satellite in orbit today, there is virtually no backup option waiting on the launch pad. The financial engine sitting on top of those rockets is Starlink. In 2025, the satellite network generated $11.4 billion in revenue. It routes global maritime shipping traffic and provides the operational backbone for military forces in active combat zones. This functional monopoly over low Earth orbit creates a compelling sales pitch for Wall Street. But that narrative of total dominance masks the financial and physical liabilities accumulating out of view. The physical reality of the Starlink network is much harsher than the IPO paperwork suggests. The current workhorse of the fleet, the V2 Mini, has been struggling to stay active. This visualization maps out the failure rate. Out of the roughly 11,600 Starlink satellites launched, more than 1,500 have already deorbited. Tracking data shows entire batches failing due to thruster problems and fuel leaks, forcing them out of the sky months into their deployment. To manage the safety risk of dead satellites causing collisions, SpaceX dropped the main operational altitude down to about 300 miles. Maneuvering down into that denser atmosphere burns extra fuel immediately. That leaves less fuel to maintain position over time, dramatically shortening the lifespan of the hardware. Every time a satellite dies early, the company loses subscription revenue, and they have to spend a Falcon 9 launch replacing it instead of expanding the network. That constant cycle of physical replacement drains the exact cash flow needed to justify a $1.77 trillion valuation. The most significant drain on that cash didn't come from orbit. In February 2026, just months before the IPO filing, SpaceX absorbed the artificial intelligence startup xAI in an all-stock deal. By folding in xAI, SpaceX also absorbed the liabilities of the social media platform X. That included the remaining balance of a $13 billion buyout loan. The interest bill alone on that debt runs over $1 billion a year, or roughly $3 million every single day. Before this merger, the different companies sat behind strict corporate walls. Now, the billions of dollars Starlink generates can legally flow directly into covering that debt and subsidizing the massive hardware costs of xAI's data centers. The structure of the deal also manipulates the math. A traditional satellite business might trade at 6 times its revenue. A business labeled as AI can trade at 40 or 50 times revenue. Combining the two artificially pushes the overall valuation up by 40%, landing exactly on the IPO target. When a company of this size goes public and joins the S&P 500, passive index funds are mathematically required to buy the stock. Analysts expect up to $300 billion could flood into shares within the first year, drawn automatically from regular 401ks and retirement accounts. The capital raised here is not being stockpiled for an expedition to Mars. It is acting as an automated bailout, using retail retirement money to clear the balance sheet of private debts. This chart shows the extreme leverage involved. Based on $18.7 billion in combined revenue for 2025, a $1.77 trillion valuation gives this company a price-to-sales ratio of 94. Right before the dot-com bubble burst, Cisco peaked at 38 times sales. Regulators allowed this through a series of incremental rule changes. Over the last decade, U.S. exchanges loosened requirements to attract large listings, and fast-track review policies at the SEC enabled this complex bundle of assets and liabilities to list with minimal friction. Historical precedent shows what happens when overlapping corporate ecosystems blur the lines between their assets and debts. When Enron collapsed under the weight of its own complexity, it wiped out $74 billion in shareholder value and devastated pension funds across the country. For the private stakeholders, the IPO resolves immediate debt crises and consolidates underperforming subsidiaries. For the millions of Americans whose retirement funds will buy it automatically, it is a highly concentrated risk. SpaceX's rockets will likely continue to dominate the launch industry, but paying an irrational price for a great company rarely ends well.